Good day, ladies and gentlemen, and welcome to the 30 September 2021 quarterly update for the two CoreShares multi-asset solutions, the Wealth Accumulation and Stable Income Fund. As per usual, we'll go through a macro update in a global context and then a local economic update. And then we'll go through some of the return drivers of the portfolio to see, from an attribution perspective, what was driving risk and return in our portfolios. From a global perspective, COVID is still a big talking point. The number of cases exceeded 230 million globally, from some 85 million in the beginning of the year. And of course, there's a large ramp up in COVID cases, but a concerning Delta variant that had entered into the market in the third quarter and is a cause for concern. It must be said, though, that the developed markets continue to aggressively roll out COVID vaccines. The US looking at booster shots and multiple other developed markets really doing well in terms of the vaccine rollout initiatives. However, in contrast, emerging markets continue to struggle in terms of actually rolling out the vaccine and getting high penetration rates across their population. Globally, the quarter from a financial markets perspective started off relatively steadily through July and August. However, there was some uncertainty that entered into the markets into the last month of the quarter, mostly driven by some concern, as mentioned previously, around the Delta variant, but also around the interest rate environment, where previously interest rates were only expected to increase post 2022. There's now expectation of an interest rate increase before the end of 2022. This on the back of the Fed's meeting in September, and also, in addition to that, the expectation that tapering may start as soon as November. So that the bond buying back program to start to taper that off, the Fed will start tapering that off sooner than what was previously expected. So this initiated a risk-off sentiment globally, where the first 2 months saw equities, DM and EM, performing relatively well. The September month saw large negative months in dollars across both developed markets and emerging markets. Developed markets essentially giving up all of their gains in July and August in September, and emerging markets coming under increasing and significant pressure with a rotation out of risky emerging market equities into more stable DM equities, and in some instances into less risky assets. So really what the big agenda item and the big talking point was the Fed meeting, was the interest rate expectations and tapering coming sooner than potentially expected. Also, a lot of policy uncertainty in the US, and the expectation of Powell's renewed term in the Fed starting to look less certain than perhaps it was coming into the third quarter of 2021. Locally, we now have COVID cases exceeding 2.9 million from, say, 1 million in the beginning of the year. So also big ramp up, but the high numbers of, say, July and June starting to taper off, and combined with what's fair to say, an inconsistent vaccine rollout coming in fits and starts. We're now sitting at close to 16% of our population fully vaccinated, with quite a long way to go to penetrate, deeper into the population, to achieve a more acceptable level of vaccination. The big local talking point was, repo remained unchanged over the quarter with unanimous votes. To keep repo constant, where the prime lending rate is now 7% and repos at 3.5%. This is the 7th consecutive Remain decision, and this on the back of CPI, within expectation. CPI, headline CPI at 4.89. So the kind of shock from the first into the second quarter, where CPI jumped up quite considerably. CPI is now stabilized. But this on the backdrop of weak economic growth. A lot of this is just simply a lag factor from some of the looting activity that happened into the end and the beginning of the second quarter and beginning of the third quarter. So economic growth is weak, investor confidence down and business confidence down, largely on the back of of looting, which came into the, as I mentioned, the end of the second quarter, the beginning of the third quarter. The rand weakened approximately 5% relative to the USD over the quarter. Most of that weakness came in the last 2 weeks of September, in line with the global risk-off sentiment. Big South African bond sellers, seeking liquidity in emerging markets. South African often gets targeted because it's got a large liquid bond market. So, sell-offs in our nominal bonds, also more attractive rates out of the US meant that on a relative basis, our rates were looking less attractive. So big sell-offs, and that led to some rand weakness over the quarter. Notwithstanding fairly, stable rand year to date. So this rand weakness is came in the last 2 weeks of the quarter. Big corporate action that happened, not necessarily a macro event, but at a stock level, an extremely important event for our portfolios and for our clients was the Naspers Prosus corporate action, essentially Prosus issuing a large number of shares, buying roughly 50%, 49.5% of Naspers. And this was a large corporate action. This actually was one of the largest trading days in recent history on the JSE, to the point where the JSE had to close the following day up until about lunchtime because they were trying to match the very large number of trades that went through the market. Realistically, what does this mean for our indices? What does it mean for our market? Well, Naspers' weight roughly halved in our markets, and Prosus's weight went up quite significantly, around between 3- and 4-fold on the back of this. At a combined level, the combined weights, now looking more similar to a previous Naspers standalone weight. So still concentration around this particular group of assets. But a large stock event into the last in the last quarter. The wealth accumulation portfolio had a good quarter, up 3.28% of the quarter. Most of the returns being driven out of local equities and global equities. So notwithstanding some of the risk-off sentiment, our multi-factor portion of our portfolio actually performed well, driving most of the return contribution out of that equity asset class. And then on the global side, although global markets were pretty much flat, we had that 5% odd rand weakness, which is what contributed to the foreign equity positive return. And local property and foreign property, both on an absolute term being the biggest standout performers, but on a relative terms within our multi-asset solutions, having a lower weight, not contributing as much in terms of being return drivers in the portfolio. So all in all, a decent outcome for the portfolio in what was essentially a quarter of two halves, where we had stability and then a lot of uncertainty and risk off and selling. So within a risky portfolio like this, within a portfolio with a high allocation to growth assets, a nice outcome. And as I mentioned, that being driven from a bit of rand weakness, and then our local equity bucket, in particular the multi-factor bucket, performing well through the quarter. Year-to-date returns remain attractive for the strategy, with very similar return drivers. Risky and growth assets really driving return in the strategy. Of course, they also proportionately have a much bigger weight of the portfolio. So naturally, when those returns are attractive, they will contribute meaningfully to the total return of the strategy. Stable income didn't have as good a quarter. A lot of this, having less allocation to global equities, less allocation to local equities, but the dividend strategy, which forms a component of the total equity bucket, the other half being our top 50 with a cap strategy, detracting from returns as some of the high dividend paying stocks sold off into the end of the last quarter. So from a return drivers perspective, again, local property in absolute terms being a big contributor, as was global, but on a relative basis less so, with global property and local global equity and local property being the biggest absolute return drivers. However, in contrast to the wealth accumulation fund, the equity block actually detracting from return, being the largest return detractor. As I mentioned earlier, the foreign returns being mostly driven through rand weakness over the quarter to date. So a relatively benign quarter with most of return detraction coming out of the local equity block, but still an attractive year-to-date contribution from what is a more conservative portfolio with roughly 46% in growth assets and the balance in stable assets like bonds and cash and so forth. Over the last quarter, we did have an asset allocation update, not a meaningful one, but through time we've managed to optimize some of our implementation techniques, and we're able to take the global equity allocation from 27.5%, well, the global allocation from 27.5% up to 30%, and we proportionately took that out of local equity into global equity, local property into global property. So no change in macro asset allocation, rather just a change in geographic allocation. Our research and modeling and justification behind this was we have the same allocation to the same risk premium, the equity and property risk premium, with more diversification. So it ended up being a decision taken in the quarter of last year, and proportionately the same shift in the stable income fund. So a shift out of essentially local equity and into foreign equity, a proportionate shift. No change in asset allocation, change in geographic allocation. We very carefully looked at the income impact from moving out of local assets into global assets. We found that it was not meaningful, and we were able to increase diversification and increase exposure outside of local equities. So that's the asset allocation update for the quarter. And other than that, thank you for your time. If you have any questions, please drop us a line, and look forward to catching up next quarter.